Hi, everyone. This is Jason Bierk of Wall Street from Main Street. Welcome back to another Wall Street from Main Street podcast interview. Today's special guest is a returning guest. I just haven't had him on for a while, but I've known him for over a decade now. He's been covering global macro for over a decade. He was a gold fund manager in the past. He's a global macro hedge fund manager over at Santiago Capital, and he's famous for the dollar milkshake theory. Brent Johnson, thank you for joining me again.
Hey, thanks for having me back. Nice to talk to you again.
So, Brent, we're recording this interview on Thursday, July 27th, 2023. The dollar index has started to rally again. It's back over 101 at 101.78. But I want to get your thoughts before we talk about the de-dollarization, the newest narrative out there that the BRICS, I think in August or September, they have 40 countries and they're going to start a new gold-backed currency or partially gold-backing or something along those lines, and de-dollarization. I want to get your thoughts first on what Jerome Powell and the Federal Reserve Bank, the PhD economists, and Goldman Sachs are saying this week about how either there's little chance now for a recession or there's going to be no recession. Do you actually believe, Jerome Powell and the Fed, that there's going to be no recession?
Well, I guess at face value, no, I don't believe them. But I will tell you that I'm somebody who never says never. And I think for years now there have been people ever since the global financial crisis, and perhaps even since the dot-com crash, who have said the next Great Depression is basically guaranteed. And it's either 1 or 2 decades later, depending on how you measure that. And so, while I am of the belief that we definitely have a reckoning day coming. I don't know that it means that it's next month or next year. Maybe it's 2 or 3 years from now. So, yeah, I guess that's the best way to answer your question. No, I don't. I don't have tons of faith in the Fed. No, I don't think their forecasting ability is very good. And when they come out and say things like, we're not going to have a recession, I don't understand why they even say stuff like that. It would be better just to say nothing.
Do you think it's because they're trying to talk bond yields, the yield curve a certain way? Because the yield curve's inverted, and yet here we have the talk on CNBC and Bloomberg about a new bull market in stocks. The stock market, I think I just saw on Fox Business today that the stock market hasn't rallied this much since 1897, some weird type of number, talking about a bull market rally in stocks. But it seems that there's a big divergence here between the asset markets and the real economy.
Yeah, so I think the stock market is a little bit different reflection than the actual economy itself. And I think the stock market is in very many ways front running an expected pivot by the Fed back to easy monetary policy. And as such, they're kind of fighting the Fed, right? And so I don't necessarily think that the stock market reflects what's going on in the real economy. But what I think is kind of interesting with the Fed, and this is my take on Powell, and I think some people will probably disagree with this, but this is just my take, and that he has been for the last couple years, and I've said this on several occasions, that I think he's probably the most clearly spoken central banker that I've ever heard, at least during my career. He's I don't think he's trying to trick anybody. He said pretty clearly that he was going to raise rates. Most people said he wouldn't be able to. And yet over the last, 15 to 18 months, he's taken rates from 50 basis points to 5.5%, right? And he kept saying, I'm going to do it. He kept saying inflation's my number one concern and I have to get that back down. And I think a lot of people thought that the economy would roll over and that the interest rate hikes would cause the economy to roll over quicker than it has. And I'm also of the belief that Powell thought it would cause the stock market and the economy to roll over before it has. And what I mean by that is the reason he was raising rates, the whole point of raising rates in that environment is to slow the economy down. And their belief, now people may not believe this themselves, but the Fed's belief is that if they can control growth and if they can slow down the economy, then that will slow down inflation. And by doing that, they can get inflation back down to 2%. Now, I don't think they actually want to get inflation all the way back down to 2%. I think they'd love to have it at 3.5% or 4%. But they're not going to say that. They're going to say that they want to get it down to 2%. And so I'm of the belief that last year, Powell thought that raising rates would cause a recession. And I think he was okay with it causing a recession. I don't think he wanted to collapse the system, but I think he was okay slowing the economy down in a way that would cause a recession. And I personally think that he's actually surprised at how far he's gotten as well. And when he started the rate hiking cycle, I don't think that he probably thought he had as good a chance to stick the soft landing as he may have said. But as he's gotten closer to doing it, I kind of feel like he's like, oh my gosh, I might actually pull this off, right? And so as rates have increased over the last year and a half, and as the market over the last 6 months has rallied right in the face of it, I think he's looking at things now and saying, you know what, I might actually pull this whole thing off without causing a recession. Now, I don't agree with him, but I just think that's probably what he's thinking. And as a result, that's why I think he's been, over the last 6 months, even though he's continued to say he's going to raise rates, and even though he's continued to say that 2% is his inflation target, he hasn't been as forceful about it. He's been a little bit more wishy-washy on the language. He said, we're getting into restrictive territory. We're probably, we've come a long way. We probably don't have very much further to go. And so that's where I kind of think that we're at now. I think he can see the light at the end of the tunnel, or in his mind, he sees the light at the end of the tunnel, and he's trying to take this smooth glide path into the no recession Goldilocks scenario. I think he's going to fail, but I think that's my take on where we're at right now with it. And I think that's why he's saying the things that he's saying.
The narrative coming out of the Fed right now, no recession, reminds me a lot of the calm before the storm, 2005, 2006, 2007, because similar in that time period to now, we're seeing bad news stories every single day, just worse and worse headlines about commercial real estate now, similar to residential real estate. But there wasn't any major bank failures. So the last one, there were smaller regional banks. But I think the Fed, Brent, is going to fall victim to the lag effect. So they did increase interest rates at the rapid hike. We haven't seen, to my knowledge, in financial history, a bull market in stocks was an inverted yield curve. But I think really those interest rate hikes, it takes a while for the economy to kind of start to price them in with higher cost of capital. I saw you on a panel a couple of days ago on Complete Intelligence, and you were going through what the increase in bankruptcies, it's up 68% here in the US, and it's on pace for a record year. But according to one of the other guests on the panel that you were on, he was saying that a lot of the banks haven't even marked to market the value of the loans yet. So they haven't written off the loans yet, and we still have a record pace for bankruptcies.
Yeah, and that's why I say I think that the underlying economy is not as in a good shape as the stock market reflects. To your point, a very good point is that the lag effects of the interest rate hikes is something that's been known for a while, but I think people don't appreciate it as much as they probably should. And so, and I'll tell you what I mean by that, and I'll explain a little bit more detail. For most of this year, I have been saying that I expect us to have a pullback and a correction. And I laid out all the reasons why, most of them which you're probably familiar with. But I also said the thing that the thing that could potentially cause me to be wrong, and I admitted this back in December, January. I said the thing that could cause me to be wrong is the lag effect. Because whenever the yield curve inverts, it's almost a perfect indicator that we have a recession coming. It almost always, predicts one. But what most people who say that don't also tell you is that it usually takes anywhere from 9 to 18 months to show up from the time the inversion happens. And during that 9 to 18 months before the recession shows up, equities tend to do really, really well. Historically, when the yield curve is inverted, for the first 6 to 9 months, even a year, equities rally. And so while I'm not shocked that equities have rallied, I kind of understand why they have, but I think we're getting kind of long in the tooth here. I think at a minimum, we need to pull back and take some of the froth off. And a lot of it has to do with the fact of the lag effect. And for those who aren't familiar with what the lag effect means, it basically means they've been raising rates for a year. But if you didn't have a loan that was coming due over the last year, and let's say now it comes due in August, and now you're getting refinanced at 8% rather than 4%, well, now your payment is doubling. That wasn't the case 3 months ago, 6 months ago, or 9 months ago. But now, as interest rates have basically gone up 500% or more, and refinancings take place, or new purchases, if a building gets sold or a house gets sold and now it's at a higher rate, well, that those higher payments start to kick in. Those higher payments now go to servicing debt rather than spending money in the broader economy. And so I think that's one of the reasons why I do think we are in for a pullback. As of right now, I'm not of the opinion that we're going to have this big Great Depression. I don't think that we're necessarily going to have the monster crash. I won't rule it out. I'm kind of prepared for it. But I think it's going to be, I think today, like today, I think it's a relatively easy decision to take a little bit of money off the table in equities. I think if we get a 10 to 20% pullback, that's when it's going to get very hard, because at that point, maybe the Fed is done. And at that point, maybe the Fed is starting to think about cutting. And so today, with everything kind of at the extreme, I think it's an easier decision than it is going to be, let's say 3 months from now, if equities are 10 or 15% lower.
The other problem I think people miss, especially a lot of global macro experts, they tend to be overly US centric. So they're saying the US is not in a recession. There's the guy talking about all the hope data. But if you look at all these other countries, Japan, China, emerging markets, European Union, a lot of that global macro data is very, very bad. It shows recession or worse. So those stock markets, those asset markets, maybe except for the Japanese stock market, the Nikkei, and the US markets, pretty much all the other stock markets are in a bear market territory, not doing very well. And it seems, Brent, that we've had kind of a mini dollar milkshake where a lot of the liquidity has ended up here in US capital markets, especially the NASDAQ with the 6 or 7 large cap stocks. And then we've also had big spikes in the last couple of weeks, again, after a lull in the shadow liquidity programs where the banks are supposed to use the capital, for residential real estate loans with the FHLB, the BTFP, the Fed's discount window. And I don't think all the capital is ending up in residential real estate. I think it's ending up in the stock market.
Well, it certainly feels like that. And again, it kind of, translates back to what's the underlying economy doing and how things are trending there versus how the stock market is trending. And, there's been a number of these charts that have gone around. I don't have one right in front of me now. Again, whether it's, stock market versus bankruptcies or credit versus stocks, or and they're basically these alligator jaws where for years they were correlated. And now this year, the stock market continues higher and the thing that it's compared against is now falling. And the question is, well, which is going to happen? Are equities going to catch down, or are these other things going to catch up? And I'm of the opinion that more likely than not, the equities are going to fall to reverse that correlation or to bring that correlation back into step.
Well, it depends on the liquidity programs. I mean, if
Sure.
if there's going to be all these shadow liquidity programs and the large banks are going to get away with bumping FHLB up to 2 trillion, and some of these other BTFP and these other liquidity programs in these other governments, these other central banks are going to do their versions of QE or shadow liquidity programs. It seems the capital is ending up here.
Yeah, no. Well, again, you don't have to. I won't argue with you too big on that. I'm a big proponent that in the last few years and in the years ahead, that capital from around the world will find its way into the United States market as the cleanest dirty shirt, or however you want to describe it. I've kind of historically called it the milkshake, but there's many different analogies that could be used for it. And again, it's not because I don't recognize the problems in the U.S. There are innumerable problems in the U.S. We could probably spend the next 10 hours talking about them in detail. But the issue is that everywhere else has the issues as well. And in some cases, those issues are more severe overseas than they are in the United States. And in many places around the world don't have nearly the advantages that the United States has. And going back to what you've been talking about, these liquidity programs and the actions of the Fed or the Treasury, whoever it is, many times over the last 15 years, especially since the global financial crisis, I've heard people say, well, the Fed is out of bullets. This is the last thing they're going to be able to do. And I would just really caution people against taking that belief. I mean, these central bankers, monetary authorities, governments, they are extremely powerful. And I don't think that they are out of bullets. I think that they have many bullets left in their gun that they can still shoot. So the idea that they are at the end of their rope, there's nothing else they can do. Perhaps that's correct, perhaps. But I think that's a very dangerous assumption to take as a given. Because every time we do get their job is literally, this is the whole reason central banks were created, is that when things get bad, that they can provide liquidity. So the idea that they are not going to, and it doesn't matter whether it's legal or not, by the way, they'll just change the law if they have to, right?
That's part of my stagflate tax lie thesis, yeah?
Yeah, exactly. So, the idea that central bankers are at the end of their rope, there is nothing else they can do. And as a result, this is a guaranteed outcome. Again, how many people a year and a half ago thought that Powell could take rates to 5.5% and the stock market would be within 2 or 3, 4% of its all-time high. I don't know more than maybe 1 or 2 people that would have predicted that, but here we are. Now
With an
again,
inverted
I
yield
don't
curve
think it's
too.
I don't think it's going. Yeah, again, I don't think it's going to last, but so far they've done it. So, and that's why I say anybody who has certainty right now, it's really doing themselves a disservice. It doesn't mean that you're going to be wrong, but just don't be certain about anything, because this is about as uncertain time as I can remember. I've been doing this close to 25 years now. In that 25 years, I've seen the dot-com crash. I've seen the subsequent real estate bull run. Then I saw the global financial crisis. I've seen Volmageddon. I saw, the Euro crisis. Then we had COVID. Like all of, I've seen a lot of booms and a lot of busts over the last 25 years. And I think this is as uncertain and hard a time to manage money as any time I can remember. So it's always a little surprising to me when I talk to people and they think they have it all figured out.
Yeah, I totally agree. And they change the rules. The Fed changes the rules all the time. And then if the Fed's not going to get a full audit, I mean, look at all the stuff they've gotten away with the last 15 years. There's been tons of currency swap lines. That's prevented that dollar super spike, because that would be a global margin call on all that dollar denominated debt, whether it's in the Eurodollar system or it's in dollar denominated debt in emerging markets or China from governments or foreign corporations. So the Fed just there's always a new liquidity program for the Fed to create. I think in the last 2.5 years, they created a permanent repo program for foreign central banks. They created a domestic one. They just created the BTFP. I mean, look at all the programs that they created to try to prevent a total collapse.
No, absolutely. And again, that's their job. So, I think you have to be prepared for them to do things like that. One thing I would point out is, we've talked about, the underlying economy in the U.S. is perhaps not as strong as is reflected in the stock market. And we briefly touched on that things aren't great overseas as well. I continue to believe the belief that if we have another global crisis, because I think it's going to be very hard to have a regional crisis at this point. I think, things have been stretched to a level where if a big crisis happens in one place, then it's probably going to spread. I think it's just as likely that a crisis starts overseas as it is that it starts in the United States. And I've had people tell me, well, Brent, earlier this year, we had the banking crisis. It did start in the United States. And I'm always kind of quick to point out, well, no, it didn't start in the United States. 9 months ago in August and September of last year, the Bank of England had to intervene in order to save the gilt market. The Bank of Japan had to intervene to save both the JGB and the yen market. And the ECB had to set up a facility to buy Italian BTPs because those yields were blowing out. And
yeah, I agree.
So it didn't start here first. And then the other thing that I think people need to remember is let's focus on the bank crisis here in the United States. What caused the bank crisis here in the United States was that these banks had bought a lot of very low yielding treasuries. And then when interest rates rose, the price of those treasuries fell. They weren't marking them to market because they didn't have to. But then when people started taking their money out of the banks and they had to liquidate those securities, then they started getting marked to market. Their capital ratios fell, and all of a sudden they were out of business.
Well, the banks are also sitting on bad commercial real estate loans. Let me add to some of your points. So you brought up the gilt market in the UK. You also had a pension. From what I heard, and I've spoken to different sources on this, there was also one or two large pension funds in the UK that was about to fail on a leveraged bond trade too, and they were bailed out.
Yeah, exactly. It's all kind of related there. But the point I wanted to make was that the reason that we had the bank crisis here in the US was basically because the banks were holding low yielding treasuries. Well, what they were not holding was negative yielding treasuries. But you know who is holding negative yielding treasuries? The Japanese market and the European market, because those markets, those central banks, the ECB and the Bank of Japan, took rates negative and held them there for 8 to 10 years. And the banks and the insurance companies and the pension funds all bought those, and the big mutual funds, bought those negative yielding European sovereigns and Japanese sovereigns. So if and when those interest rates rise, that's going to cause a problem in those markets as well. And that's why I think the crisis could come from abroad just as easily as it could come from inside the United States.
or those insurance companies have derivatives that are connected to American insurance companies or large American banks. So this whole thing is interconnected, unfortunately.
Yeah.
So basically, you're saying then, as the euro has gone weak against the dollar for the last couple of years, they've had whether you believe the government data or not, they've had relatively worse inflation or stagflation for the last couple of years compared to the US. So with the negative yielding debt, the negative rates on that debt, as inflation increased, as the ECB debated raising interest rates, so all that old debt is going to blow up then.
That is my belief. Yes.
Wow, that would be bad. My friend Daniel Akaye was writing about zombie companies 6 or 7 years ago. So I mean, those zombie companies at higher rates, I mean, they have a lot of private sector problems in their economy too.
Well, see, and that's what's different now between now and either 2020 during COVID or 2008, versus the global financial crisis, is in both of those scenarios, we were dealing with deflationary pressures. The problem now is that because of the effects of COVID, it's funny because we have both deflationary and inflationary pressures right now. It's kind of stagflationary depending on where you're at and what you're looking at. But because there are inflationary pressures now that weren't here in 2020 and that weren't here in the late 2008 or 9, it will make it harder for central banks to immediately react to a downturn using the same policies that they did before. And so I think everybody knows that interest rates were at 5,000-year lows until 2 or 3 years ago, and now they've started to rise. And because of all the debt, the world just cannot withstand higher interest rates. But because of the inflationary pressures, higher interest rates is what the central banks continue to do or continue to address. And, everybody's focused on, or not everybody, a lot of people seem to be focused on the increased expenditures of the United States to service the United States debt. But the same is true for Europe. The same is true for Japan. The same is true for China. The whole world is dealing with this same issue. And that's why I think it's going to be very hard to have just a regional crisis. I think it will very quickly, or at least has the potential. And I think people need to be prepared for a regional crisis to spread and kind of have global contagion effects.
I think also what people don't understand is how much dollar denominated debt's floating around out there. So this thing has worked in a cycle, and it's kind of why the dollar index for 8 years until recently was in a pretty wide trading range from around 87 on the dollar index to about 104. It was in a trading range for almost 8 years. Maybe it's in a higher trading range now. But every time the dollar got weak on the dollar index, you saw more foreign governments and more foreign corporations borrow more dollar denominated debt. So there was the narratives out there in public that we're going to de-dollarize, we're going to set up a new system, we're going to do petro yuan, crypto, go back petro yuan, crypto yuan. Yep. One of them was Belt and Road Initiative, but Tony Nash, and I've interviewed Tony Nash, and I'm friends with Tony Nash, and he said that he worked on the Belt and Road Initiative, and they were using dollars. They weren't using Chinese yuan. Yeah. So all these narratives about we're going to de-dollarize for the last 10 or 15 years, I mean, that's just a narrative out in public. The reality is that every time the dollar got weak, foreign governments and foreign corporations borrowed more dollars.
Yeah, that's exactly. And I'm glad you brought this up, because this will give me the opportunity to kind of help set the record straight on the whole dollar milkshake theory to begin with. Part of the reason that I have pounded the table so hard on the dollar and the dollar milkshake theory, not so much because I'm absolutely 100% convinced I'm right, and not because I want everybody to go out and sell everything they own and buy dollars. Part of the reason that I have pounded the table on it as hard as I have is to help to dispel some of these myths surrounding de-dollarization. Now, I'm the first to admit that the desire for de-dollarization is there. I'm the first to admit that many attempts have been made and are continuing to be made, and perhaps even the frequency with which they're trying to be made is increasing. But the hard reality is that the success level of these attempts has been next to zero. And the whole world is more entrenched in dollars today than at any time in history. Now, it doesn't mean that they're not trying to get out from underneath it. It doesn't mean efforts aren't being made. But the reality is the more they struggle, the tighter the trap gets. It's just based on the design of the system. And I want people to understand that, because I think a lot of times people just, grab onto these anti-dollar narratives because they kind of sound correct. And it kind of makes intuitive sense until you understand how the system is actually designed. And then all that stuff starts to kind of fall apart one by one. And this latest one with the BRICS going to launch a gold-backed currency next month at their meeting is a particularly interesting one because it's coming on the heels of, Russia invading Ukraine, and it's still going on. And then, relationships with China and the United States have kind of soured over the last couple of years. And so, and the fact that the U.S. perhaps, in my opinion, kind of overstepped their bounds and, confiscating reserves. And, I think in hindsight, that will probably be seen as a bad move. But for all those reasons, the whole de-dollarization narrative kind of makes more sense right now. And so I think because people think it makes sense, then that means it's automatically going to be successful. But the reality is that doing this is immensely harder to actually implement than it is to talk about. And the reality is that since the BRICS were first founded in 2009 was their first meeting, they've talked about this, ever since then. And ever since then, we are going to have a plan to eventually develop a system that will allow us to one day de-dollarize. But it's always out in the future. And again, it's always politicians saying this. It's never the big businesses. It's never the CEO of global corporations saying, I want to no longer use the dollar, right? The whole Eurodollar market started back in the 50s and 60s to begin with because private enterprises wanted to use the most demanded currency on a global scale, and that was the dollar. And the reason that countries continue to issue dollar debt and use dollars partly is because it's the most demanded currency. And because it's the most demanded currency, when they finance in dollars, they get a lower rate. And that's why when the dollar falls, they think, okay, well, I'll go borrow in dollars. And as the dollar continue, and I'll get a lower rate than borrowing in my own currency. And then as the dollar falls, I'll be able to pay off that dollar loan even easier, as my currency appreciates. But the problem is their currency never appreciates for more than like 6 months or a year. I mean, if you look at it,
or the foreign government doesn't want their currency to appreciate, or the currency peg that China is running. Yeah,
exactly. No, you're 100% right, Jason. And so, when you start to kind of understand the intricacies of the Eurodollar system, and for people who aren't familiar with Eurodollars are just dollars that exist outside the domestic United States. When Japan makes, when they do some kind of vendor financing with a supplier out of the Philippines and it's denominated in dollars, that's Eurodollars. Or when France makes a US dollar loan to a manufacturing company in Turkey, that's a Eurodollar loan. And so, I think a lot of people have heard over the last year that the US now owes $31 trillion in debt. Well, the fact of the matter is the rest of the world also owes over $30 trillion in US dollars. And they don't owe it to the United States. They owe it to each other. And so, I will often hear people tell me that they're just, to get out from underneath the dollar, they just have to default on that dollar debt. Well, if they default on the dollar debt, they're not defaulting on the United States. They're defaulting on each other. And not only that, if you start defaulting on debt, then you get a credit contraction and dollars start to disappear. And when dollars start to disappear, but they're still in demand, price rises. And that's why every time over the last 25 years that we've had a global slowdown or some kind of a crisis, the dollar rises because it's a simple supply demand issue. Now, you as an individual may think it's stupid to have a desire to have dollars. But the fact is, the business world, the commercial world, to operate on the global stage today, you need to have access to US dollars. That may change someday. And I think in many ways that would be a good thing if that changed someday. But as of right now, today, if you want to be an operator on the global stage, you need access to US dollars. And that's not going to change tomorrow. It's not going to change next month, and it's not going to change next year. It's going to take years for this to work itself out. And it's my opinion, as it works itself out, you're going to see the dollar rising, not falling.
Well, there's been very little progress made with de-dollarization the last 15 years. And the problem, I think, and we see this with the gold community and the Bitcoin community the last decade or so, especially the gold community, is that every time there's a new proposal by the BRICS group for a new type of way to de-dollarize, they just jump on it and say it's going to happen and it's going to create de-dollarization rapidly. And then a year or two later, no results whatsoever, and then it's on to the next de-dollarization proposal, and then it's kind of it's mentally worn me down. But the reality is de-dollarization, Brent, and I think I've studied this, I've looked at SWIFT. Yeah, Russia and China are trying to set up an alternative SWIFT because Russia got kicked out, but are they going to do any of the type of volumes like a Visa, MasterCard, cross-border trade settlement that the Bank of International Settlements or other large-scale entities handles with global trade? I don't think they're scaling it at anywhere near the pace that the current systems that we have in place with using dollars is.
Well, again, that's a very good point. And, of course, there's always a way to get around the SWIFT system and the ways to get around the official channels. I mean, black markets are as old as history, right? There's always a way, but they're not as efficient. The pricing isn't as good, and it's just logistically more difficult to use. So, of course, China and Russia are going to try to find alternative ways. But the idea that just because they're going to try to find an alternative way, that means that they're automatically going to be successful are two different things. And I'm not saying to ignore these things. I'm not saying not to study them, not to look at them, not to keep track of them. I'm just saying don't automatically accept them as a fait accompli just because a couple politicians say that they're going to do it. It's just much more difficult to actually pull off.
Yeah, it's very complicated because here we are 15 years later since 2008. And that's when we started seeing and hearing the de-dollarization was during the 2008 financial crisis. And the foreigners were very upset with all the bailouts. And yet very little has actually been accomplished with de-dollarization 15 years later.
Yeah. And, I should say here, because I don't want people to get the wrong impression, I'm a huge believer in gold. I think everybody should own gold in their portfolio. Where I think I'm a little bit different than maybe some of the traditional operators in the gold world or the gold community is I think gold is just fine all by itself the way it is. I don't think you need to make up some crazy story of why it's going to go to 10,000. All you got, if you believe in the power of markets and you believe that gold deserves a spot in the higher echelons of financial assets, then just buy gold, hang on to it, and when the politicians fail, gold will do very well. But one thing I would say with gold will go a lot higher because politicians fail, not because they do something really smart. And the idea that the Soviets, or the Russian government and the Chinese government and some of these BRICS are going to get together and they're going to do something really smart and really efficient and done really well, and they're all going to cooperate. And as a result, gold's going to go higher. I just think that's wrong. I think gold's going to go higher because they're going to try to do something and they're going to fail. And when I say the U.S. is going to have failures as well. I mean, I ultimately think that you're going to see the dollar and gold rise together versus all the other currencies. And again, not because they do something smart, but because they fail and because they do something stupid. But I don't think we need to make up some fantastical, stories about the BRICS are going to start this, this union, and they're going to have this super efficient currency system, and they're going to trade amongst themselves, and they're going to settle it in gold. To me, it's just illogical that that's the way it's actually going to work. Now, can I be wrong? I can absolutely be wrong. But I think history and I think also just common sense is on my side here.
Yeah, I think smart people are accumulating gold, silver, commodities, maybe a little bit of Bitcoin. They're doing so because they don't trust their government. They don't trust their politicians. They don't trust their central banks to have good policies, to do the right thing. I mean, we're just seeing tons and tons of bad policies from all these governments, all these central banks. They're anti-individual, anti-freedom, they're anti-free market. A lot of them are even anti-capitalism at this point.
Yeah, and this is kind of one of my things too with kind of some of the people in the gold and the Bitcoin communities is they will say gold and Bitcoin is the money of freedom and liberty. Okay, I can get behind that. I can agree with you on that. But then when they also tell me that China and Russia are going to go to a gold standard or they're going to start using Bitcoin because of game theory. Okay, do you really think that China and Russia are the bastions of freedom and liberty? Now, again, I get it that perhaps the United States isn't either, and perhaps our rights are being trampled upon, and we don't have nearly the freedoms that we used to have. But on a relative basis, do you really think that China and Russia are more free or have embraced liberty more than the United States has? Because that's kind of what you're arguing, is that these two countries that have two of the biggest strongmen of the last 100 years running those countries are all of a sudden going to give over power of control of one of their biggest tools, which is their currency, to gold, and as such provide an increased amount of liberty and freedom to their citizens. The dichotomy or the inconsistency of those two arguments, to me, is just too much to overcome, and I think you got to really look at that critically if that's your belief.
So you said there's 30 trillion of dollar-denominated debt outside the United States. I've seen estimates from the Bank of International Settlements in the recent report. There's only 13 trillion. So what are you counting in that 30 trillion estimate? Are you adding in the amount from the Eurodollar?
Well, I can send you the report. It's also from the Bank of International Settlements where the 31 trillion number comes. And then not only that, but they also have another study that they put out where their estimates of the off-balance sheet derivatives and swaps add up to about 70 trillion.
Wow. The Chinese banks have a lot. I know Kyle Bass has been talking about this for years. The Chinese banks have trillions of those.
Yeah, exactly. And that's the thing is with this Eurodollar market, a lot of it's, it's not, it's very opaque and it's hard to measure. And because it's in the offshore and these shadow markets, it's not reportable and it's not regulated. And it just gets very, very hard to measure. I'll tell you, the last time a financial, at least that I know of, if somebody has information that disagrees with this, I'd love to see it. But from what I understand, the last time that a financial institution really took a hard measure of trying to figure out how big the Eurodollar market was back in the 90s. So it was about 30 years ago. And at the time, I think it was Morgan Guarantee. And at the time, the M2 of the Eurodollar market was, I think, double the size of the US M2 market, right? And this was 30 years ago. And if you understand how the system is designed, the monetary system has to grow to survive because it's fractionally reserved. It has to grow. If it doesn't grow, then it kind of collapses on itself. And so if you think about how much US M2 has grown over the last 30 years, and you know that in order to not crash, the Eurodollar market had to grow even faster than that, you can see why the Eurodollar system is orders of magnitude bigger than the US dollar system.
And I also think the average person doesn't think about this logically, but when dollar-denominated debt grows, there needs to be more dollars to either service that dollar-denominated debt or to pay it off.
That's exactly right. The issuance of dollar debt simultaneously creates dollar demand.
And this is something that a lot of the a lot of the people that are like, oh, we're going to de-dollarize rapidly, they don't really understand, because you have to check it. You have to check the politicians and the governments and the central banks versus what they're saying in public with press releases, the narrative versus what they're actually doing. And in every crisis where the dollar gets weak, they borrow more dollars. So the narrative out there is that China is going to de-dollarize rapidly. And yes, China is adding a lot more gold tonnage. Yes, they're stocking warehouses. They're building new warehouses full of copper, strategic petroleum reserves, 30-year deals with liquefied natural gas. But on the other hand, inside China's economy, inside China, their banks, their shadow banking, there's trillions, many trillions. I don't know the exact estimate, but it's at least 8 or 9 trillion of dollar-denominated debts, probably even more than that.
Yeah, it really, all countries, again, if you're going to operate on the global stage and be a global power and be a global player, you need dollars to operate. A lot of the borrowing in the domestic real estate market in China was done in dollars. A lot of the funding of the Bridge and Road Initiative, which you referenced earlier, was done in dollars. So this idea that, all these countries are just going to stop using dollars, again, it's not that the idea is not out there. It's not that they're not making efforts, but we're not going to wake up tomorrow and no longer have any dollar demand. And I think it's really important to kind of understand that.
Okay, so
and again, the other thing I should point out here, Jason, is I think it's one of the things I've learned over my career, and this is very hard to do sometimes. But what you really have to do is you have to separate what you would like to see happen and what the facts tell you is actually going to happen. I don't necessarily like the system the way it is. I don't consider myself an advocate for the U.S. dollar and the system as it's currently designed.
Oh, I agree.
But I've spent many years studying it and trying to understand it, and I just try to share everything that I've learned in the most simple manner that I can. And when I first started figuring this out, part of the reason I thought I was on the right track is because I hated the answer. I didn't want it to be this way. I didn't think it was fair. I didn't think it was morally correct. But the more I studied it, the more I realized it doesn't really matter whether I like it, doesn't matter whether I think it's fair. This is the way it actually is. And when you're putting your hard-earned money on the line, you don't want to necessarily have your feelings wrapped up in it. You kind of need to be kind of a cold-blooded assassin when it comes to managing money. Now, if you want to try to change the world and you don't mind putting your money on the line to try to change the world, now that's something different, but that's a different goal. If your goal is to increase your portfolio, then I think you need to try to, at least to a certain extent, or to, kind of remove your emotion of what you would like to see happen and just figure out what the facts tell you is actually going to play out.
Yeah, I think the problem is the global financial system. We're over 300 trillion in total global debt at government, corporate level, all the different levels of debt, and yet it's grown enormously since the 2008 financial crisis. The problem is what fractional reserve banking, debt-based fiat currencies, how much credit has grown, especially dollar-denominated debt. And then it seems, Brent, that every time, do you think then in a deflation scenario or a dollar super spike, is that basically a global margin call then that threatens to collapse the entire system?
Yeah, I mean, and we started to see the shades of it last year. So let's go back 9 months ago, August and September. So about 9 months ago, the VIX was as high as it had been in 2 years. The dollar was as high as it had been in 30 years. Equities were at their lowest in 2 years. Credit spreads had widened, and Bank of Japan, the Bank of England, and the ECB were all intervening, and China was intervening in their real estate market to keep their economy going. We were on the verge of another crisis 9 months ago, and it was a global margin call on the dollar. The dollar was at 114, I think, because everybody needed dollars. You saw the same thing happen in 2020 during COVID. The dollar. If people remember at the beginning of the year in 2020, the dollar was around 96, 97. We got close to COVID. The Fed cut rates. The dollar went to 94. 10 days later, it was at 102, and the whole world was on their knees begging for dollars because all assets were just melting down. I mean, that was a margin call on the dollar as well. 2008 was largely a margin call on the dollar. And that's why I say you don't really have to...
Repo crisis too.
Yeah, no, exactly. And that is, I have a chart that goes back over the last 25 years. Every time there's been some kind of a global slowdown or some kind of a crisis, you see the dollar rally. And the reason is that the dollar is the underlying collateral off of which the entire system is levered. And so, it makes sense when the asset prices come down, then the dollar rises. That just kind of makes sense. So the idea that we're going to have this depression or this collapse in asset prices and the dollar is also going to fall, that just doesn't square. That's just not the way the system is designed.
Well, I also think the Fed can't allow real deflation then with credit defaults, bankruptcies, asset prices falling, government tax revenues collapsing for long periods of time, which is why then they start issuing new liquidity programs. They start wanting to re-liquefy the system because that means dollar goes up, asset values go down, government tax revenues collapse. The tax revenues from the private sector that the government was anticipating and projecting, those collapse. And then the Fed has to expand the balance sheet to do QE to plug the holes with the tax receipts that have collapsed in 2008 and 2020.
That's exactly right. I mean, and again, that is the reason that the Fed exists. That's the reason that central banks exist, is because when liquidity dries up, they need to be the lender of last resort. If our system was designed differently, you wouldn't need a central bank. But because of its design, a central bank needs to be there to keep the collapses from happening. And listen, I know that there's people out there saying they shouldn't do that. They should just let asset prices fall, let true market price discovery take place. Again, I tend to agree with that. That's real capitalism. But that's not the system we live in. And you can either rail at how you would like the system to be, or do your best to understand how it actually is so that you can make money from it.
Yeah, we don't really have free market system. The government's picking and choosing winners and losers. If you're a small business owner or a retail investor, you're probably going to get screwed. If you're a Larry Fink at BlackRock or Ray Dalio at Bridgewater, and your leverage risk parity trade blows up in 2019, you get secret bailouts.
Exactly.
So do you think then that the government wants a certain amount of inflation? They just don't want too much inflation? Because it seems that if there is actual deflation for more than a couple months, the way the system is set up with debt and debt-based fiat currency, fractional reserve banking, the system could blow up. So you seem then that long term, you think the governments all and central banks all want like a minimum level of inflation?
Yeah, well, based on the way the system, again, I keep bringing this back to the way the system is designed, because it comes back to what you want versus what you kind of have to do. In order for the system to continue operating, they cannot have sustained deflation. They can have deflation for a while, a couple months, maybe a year, maybe 2 years, but they can't have sustained inflation year after year after year, or deflation, because the whole system will collapse. And as a result, they need to kind of inflate the system to keep that from happening. And so I think in an ideal, but they also don't want high single digit or double digit inflation like they had last year. So the ideal, I think, level of inflation from a central banker perspective, again, doesn't mean an individual agrees with this, but from a government and central bank standpoint, I think like 3 to 6%, 3 to 5% is probably their sweet spot. If you could get 4 to 5% inflation over the next 10 years, you inflate away 50% of the debt. I think they would love to have that. The problem with having 8% inflation, 9% inflation, 15% inflation is that causes people to revolt. That causes people to go out in the street and shake their fists and start calling their senators and their congressmen demanding change. And all of these congressmen and senators, they want to get reelected, right? And so high or double-digit inflation is not politically acceptable. But with 3 to 5%, it's almost like people, it's annoying, it pisses people off, and it really hurts the poor, but it's manageable. From a government perspective, it's manageable, and it allows them to inflate away the debt. So they kind of have to get it into this sweet spot. And that's why I don't think the Fed wants 15% inflation, because again, it's not politically acceptable. But if they could get 5%, 4%, or 5%, I think they'd be very happy with it.
Yeah, Keynes called inflation.
They will never say this, by the way. Just to be clear, they will never say this. But that's my opinion.
Well, the IMF has said in white papers with financial repression and Japanification. So you've had some of the entities, but not specifically like the Federal Reserve Bank doing interviews and saying, well, you did have Janet Yellen years ago. She was saying that inflation was too low, but the real inflation rate was way higher than they were claiming for years. So I would make the case that the real inflation rate here in the United States was well above 2% for the last 15 or 20 years. And there's been a lot of inflation that a lot of people didn't realize for the last 15 or 20 years of at least 2 to 3% minimum per year.
Sure. And the other thing I would say also is that oftentimes people will say the Fed or the government, they're lying about the way inflation is calculated. They're lying about the actual level. And listen, I totally agree with that. But again, based on the design of the system, there is always a danger of catastrophic deflation. And so I think it's important to understand that, right? A year ago, most people didn't think inflation would fall. Or I shouldn't say, a lot of people were convinced that inflation was going to stay high and continue rising. And listen, it still might. But the point is over the last year, inflation has come down. Now, it might not continue coming down, but it has. And the reason it has come down is because of the design of the system and because the Fed has hiked rates as much as they have. Inflation is not accelerating the same way it was a year ago. Now, again, could it start accelerating again? It absolutely could.
Well, you had
but in a fractional, I was just gonna say, in a fractional reserve system where there's a lot of leverage, you can have catastrophic deflation very quickly. If you don't believe that, just go back and look at March 2020. Prices of everything fell. Commodities, real estate, stocks, bonds, gold, everything fell. Same thing back in 2008. So if we get into one of these liquidating markets where deflation takes hold very quickly because credit is no longer being extended and is actually being called in, you can get deflation very, very quickly.
I was going to say that in the 70s stagflation, the inflation came in waves. So Arthur Burns, before Paul Volcker took over, he was raising rates, but then he stopped, and people in hindsight criticized him for stopping the rate hikes. And then inflation, he thought he had it tamed. Arthur Burns thought he had it tamed, and then inflation had another wave up after that. And then Volcker really had to raise rates to much higher levels. So you might have something similar to back then happen now.
And I think that's why Powell is so insistent on continuing to raise rates. I think the ghost of Arthur Burns just scares the hell out of him, and he's just bound and determined not to have it happen.
Okay, so last question before I let you go. So the amount of dollar denominated debt you said with the Eurodollar and the derivatives, just an absolutely scary number. I mean, that's a super large number. So not quite as large as the over-the-counter derivatives, but that's one of the largest problem areas. If it is 70 trillion of dollar denominated debt combined with the other opaque stuff, that's dollar derivatives, the forwards and stuff that the large banks are doing, Chinese banks, European banks, other banks. Do you think the Fed is going to have to do bailouts for this? Have they already done bailouts? Is there anything that you know about this with bailout related?
So this is sort of kind of the heart, the whole dollar milkshake theory, really. And that is that there is an immense amount of global demand for dollars. And the Fed in the United States is the only entity that can create new dollars, other than new loans being extended. The only entity that can create new dollars is the government, the US government. So in a credit contraction, the government is the only supply of new dollars. And I think what's different now than it was in 2008 and perhaps even 2020 is that I think swap lines will be extended, but they will be extended to our quote unquote friends and allies, while they will be withheld from our enemies or those who are not playing ball, so to speak, right? And that is a huge weapon that the US dollar can use, because if they can provide funding to England and Japan and Australia, but withhold it from Turkey, Russia, and China, that puts them at an advantage. Now, everything's kind of related, so it's not quite as easy just as a snapping their fingers. There will be blowback, and it would also hurt the United States, but it wouldn't hurt the United States as much as it would hurt those countries that were being withheld from funding. So I fully expect swap lines to be extended again whenever that time is needed, but I don't think they will just be handed out like candy like they have been in the past. I think they will be used more judicially than they have in the past.
And one thing those emerging market countries have, a lot of the BRICS countries have, are besides physical gold, which they're mining in those countries, they also have a lot of commodities. So maybe then they're going to want their commodities not traded in dollars. They're only going to sell their commodities to other countries, because I mean, if they need dollars and the U.S. needs commodities, and they don't want to, the U.S. doesn't want to give them the dollars they need, then they're probably going to start withholding the commodities.
Very possibly. Again, this has the makings of a disaster, right? Now, this has been part of my argument, is that based on the design of the system and based on the levels of debt that we have gotten to, and based on the fact that interest rates were at 5,000-year lows and now they've started to rise, it's a recipe for disaster. Now, do I know for sure the disaster is going to happen? No, I don't. I just know the table is set for it. And it could get really bad because it's all interconnected. Everybody needs dollars. Interest rates are no longer where they were, and inflation is no longer where it was. And governments, will never, ever in a million years take responsibility for what they've caused. They will just double down on it. So it's for all those reasons that I think that while you don't necessarily need to sell everything you can own and go hide out on a mountaintop for the next 10 years, you do need to be prepared for volatility. You do need to have some liquidity on the sidelines in case we do get into some kind of a viral crisis, and you just can't. I just don't think this is an environment where you can throw caution to the wind and just think everything's fine.
And yet we have people with FOMO who are buying NVIDIA and the artificial intelligence stocks nonstop.
Yep. Yeah. Quite a world, right?
Well, back to risk on. Well, we also have with the money market funds and treasury. So people are pulling money out of the regional banks, and then they're going right into Treasury Direct or to money market funds, but that's hurting the regional banks because the regional banks don't have good net interest margins. So I just see more and more distortions being caused by Fed policy.
And the funny thing is we could probably keep going on this for hours, but this is another tool that the central banks can use to get governments funding, or at least in the U.S. And what I mean by that is, treasuries now pay you can get treasury bills that pay 5%, 5.5%. Why would you put your money in a bank at 3.5% or 4% that might fail when you can give it directly to the government, who has a money printer in their basement, and pay you 5%, right? And that's a way to get money from the banks and get it into the government. That's a way to fund the government, right? Now, some people say, well, that's not really what they're doing, and maybe they're not, but it's not a bad side effect if you're a government who needs money, right? So I think that's, again, there's all these, there's many tools that can still be used. There's many cards that can still be played. The idea that the U.S. government is at the end of its rope and there's nothing else they can do, I would just caution people from accepting that as fact.
And I could tell you from experience, and I've spoken to bank lobbyists, I've spoken to the trade association lawyers and lobbyists for the banking industry, the derivatives people here. I've seen them at Bitcoin and blockchain conferences here in DC. They want to change the law. So if there's any problems or trouble or bailout or something bad, I mean, you're seeing it now in commercial real estate, Brent. You're seeing the terms change for what a default is. So this is why the commercial real estate bubble, why we haven't seen more bank failures yet. They're already changing what the legal terms are for a default. Yep.
And again, that's, you shouldn't be surprised by that. Is it right? No. Is it rigged? Yes. But again, it's just, you got to factor that into your analysis that rules will change and people will be bailed out, but it doesn't mean that things aren't going to get bad, right? Just because they change this will eventually be a crisis that they cannot control. But my point is that ultimately what I'm getting at is inevitable and imminent are not the same thing. This will end badly, but it might not necessarily end tomorrow.
Oh, yeah, I don't think it's going to end tomorrow. I think there's going to be more rules changes. I mean, if the people in power, the Davos crowd, have their way, we're going to have central bank digital currencies, and they're going to keep the current system until they can transition to the next system with social credit scores, cashless society, central bank digital currencies. We'll see if things end up that way. I know that's what the economic and political elites that go to Davos want, though.
Yep. Good. Well, hey, it's good talking to you.
Yeah, I really enjoyed our conversation, Brent. We'll have you back on. Thank you so much for taking the time. And if my listeners want to follow you on Twitter or take a look at your work, how do they do so?
Well, the best place to follow me is on Twitter. I'm pretty active there. You can look up Santiago Capital. It's a black background with a white seashell on it. Santiago AU Fund is the handle. I do a show a couple times a week called the @Milkshakes Pod. You can find it on Twitter @Milkshakes Pod, and it's posted on YouTube as well. So happy to interact with people to the extent I can do so, and happy to come back and talk with you anytime.